Our inflation in Australia has largely been under control since the recession in the early 1990s. And we certainly haven't revisited the horrors of the 1970s and the 1980s caused by the black swan event that became known as the oil crisis. During that period, energy prices tripled, and our economy at the time was far more dependent on energy than it is today. Inflation stayed stubbornly high for 15 years, despite a recession in the early 80s and cripplingly high interest rates. In the end, it took a wage accord with the union movement and the recession we had to have in the early 1990s to ring in the end of this very damaging period. In August 1990, politicians passed the setting of interest rates to the Reserve Bank, and the Reserve Bank has certainly increased rates in response to any increase in inflation. Whether this has caused inflation to come down is unclear. The economy itself seems to be more important than interest rates in pushing inflation lower. You can see that inflation spiked down in response to the recession in the 1980s and then went back up again. Inflation also dropped in response to the recession of the early 90s. Both of these recessions were probably exacerbated by the high interest rates of the time. Inflation dropped after the tech wreck last decade, and also in response to the global financial crisis and the subsequent aftershocks. These later falls had nothing to do with the interest rate settings of the time. So what will drive inflation higher? If the value of our currency falls as expected, the price of the goods we import will go up. That's most of the manufactured goods we buy, because almost everything is made overseas. Energy prices are all set in US dollars, so you can expect the price of petrol to go up too. If our currency falls to 85 cents US, then the price of manufactured goods would likely increase by 25%, and petrol would cost $1.80 per litre. In the next session, we'll talk about the possibility of an economic slowdown in Australia, and if unemployment spikes up, that could put an end to inflation fairly quickly. If unemployment levels stay low, then wages may rise in response to higher prices, and then prices may rise in response to higher wages. This wage price spiral was a feature of the 1970s and the 1980s. Labour isn't as unionised now as it was then, so the prospect of a return to the bad old days seems unlikely. But an uncomfortable period of inflation is certainly a possibility. You see, even if the economy slows, there's the prospect of an avalanche of retirements, and this could easily put upward pressure on wages over the next 5 years. The chart shows that in the 1970s and the early 1980s, all of the increase in the number of people over 60 was made up of retired people, the blue bars. In fact, during the difficult economic environment of the time, the number of people over 60 in the workforce actually fell. In the latter part of the 1980s, there was some increase in the number of people over 60 in the workforce until the recession in the early 90s. Since the late 90s and into the new century, the number of people over age 60 in the workforce has been growing each year. Some of this may be due to the profligacy of a generation who haven't put away enough for retirement, and some of it may be due to people expecting to live longer and also to be healthier for longer. But you can see the numbers explode between 2007 and 2010, and this is almost certainly due to the impact of the global financial crisis on retirement savings, forcing many to work for longer than they'd planned. Since the turn of the century, the number of people in the workforce above the age of 60 has been growing steeply, and now, in a total workforce of around 11.5 million, almost 10% are over 60 and a third of them are over 65. These people won't go on working forever, and without additional immigration, we could well find the labour force in 5 years' time at about the same size as it is now. With the potential of competition for labour in an already inflationary environment, the extent and period of inflation could well be exacerbated.